Great pleasure to bring on board Prashant Jain of HDFC AMC, someone who's seen market cycles, the understanding of boom and bust, how to differentiate voice, noise and value, and how should one approach when you see a fall like this? Is it a investor friendly fall, or this is a fall which is long overdue and is going to linger a lot in terms of financial adjustment? Prashant, good morning. Thank you for joining us.
Good morning, Nikunj. Pleasure.
Let me start with a
Thanks.
very basic question. This is for the first time in this COVID bull market or the post-COVID bull market, we have seen a sizable correction, 10% plus on the index, 20% plus for 20% plus on in mid and small cap stocks. Do you think this is a much awaited correction and geopolitics and Fed is just a reason?
So, Nikunj, I would probably agree with that. And as I have often said, that real risks are not known, and I think something similar has played out. And if you recall, even in our last conversation, we had discussed that markets are expensive and one should have moderate expectations and invest only with the long-term view and be prepared for volatility. So I think the reason for volatility, of course, was not anticipated, but I would feel that this is a reasonable correction, good correction. But still, I would say it's not time to be over optimistic on the markets, but it's still time to be cautious, time to moderate expectations. And I'm sure you would have observed that companies that had weak earnings or massive earnings expectations into the futures, they have been impacted more. And this is how over time, excesses also get driven out of the markets. Yes.
Let's divide the market into three parts: short term, medium term, and the long term. We've got a maze of issues staring at us: Fed, geopolitical crisis, flare up in crude. How does your short term, medium term, and long term market outlook change given what is happening in the world?
So I think, Nikunj, short term is always extremely tough to call. And I think clearly in the short term, very short term, important would be that what kind of sanctions are imposed, what is the likely impact. Though I do feel that given the uh, scale of Russian oil and gas supply, I think very meaningful sanctions are probably impractical. So if sanctions are not too stiff, I guess market should stabilize. Significant selling has taken place, and we have seen time and again markets tend to bottom out closer to the peak of the panic. And I feel the peak of the panic is probably behind us from a very short term perspective. Over medium term, I think what will matter, I mean, focus could again come back after a few months or few quarters to US interest rates, to inflation, to economic growth, and to valuations. And there, how do energy prices behave? What kind of inflationary impact the current geopolitical environment has on energy prices remains to be seen. It could also have some impact on commodity prices. It could lead to inflation. So I think those are the variables over medium term. Longer term, I think in India, there is no reason to be pessimistic. Equities are a compounding asset class. India is a growing economy. Though I must say pace of economic recovery, which one was expecting, is at least not showing up in the credit growth as of yet, as of now. And I think that's a key variable, that key monitorable for India. I think if credit growth picks up, it would be extremely positive for India. But for now, credit growth remains quite weak.
If crude, let's say, stays above 90, stays between 90 to 100 for an extended period of time, 3 months and beyond, does that change everything then? Does that change the calculation, the assumptions, the earnings recovery, the macros?
I don't think so. See, if you recall in 2008, oil had crossed above $100. And the economy handled that situation also quite well. I think in this last 13, 14 years, our ability to digest higher oil prices have actually substantially improved. The outlook for IT demand, the outlook for IT growth, which is the key earner of foreign exchange in India, remains quite robust. So I think $90 thereabouts crude prices for extended period, India should be able to handle it reasonably well. So I don't think it would change much. But clearly, I mean, the higher oil prices go, it's negative on the margin for India and vice versa.
Prashant, before the geopolitical crisis, the world was also adjusting to inflation and what Fed would do. And markets were nervous in Jan, in Feb, early Feb. Do you think somewhere globally that Fed increase, rate increase and higher inflation, has that already been factored in from a market standpoint? Is that adjustment over?
I think Nikunj, for the short term, the focus has clearly shifted to geopolitics. And but I think as things stabilize after 1 or 2 quarters, focus would again probably come back to inflation and US interest rates. And that's why I said over medium term, we will come back to probably the same old variables. And to that extent, how inflation pans out, how energy prices behave is an important variable. But so I would say that once things settle down, whichever way they settle down, whenever things settle down, focus would again come back to the same old couple of issues.
When you say one should
And I
keep
think there is something unprecedented that has happened this time. CFIs have sold close to maybe 20 odd billion of stock, and its markets have actually not corrected. If you, in that context, I mean, a 8-10% correction with a 20 billion selling, I think is quite unprecedented. On earlier occasions, markets would fall much sharper. I think how retail flows behave also is very important. I personally feel the granularity of the retail flows is so large. I mean, crores of investors investing. I think retail flows would hold up quite well. And whenever FII selling subsides, I mean, they don't even have to turn buyers. I think that could be also an interesting uh, observation, how markets behave if and when that happens.
Okay. You're giving me a cue for my next question, which is that when you say that you have reasonable amount of optimism to believe that the asset allocation, the opening of demat account or SIPs are here to stay, what gives you that confidence? Because I can argue back and say that the new millennial crowd which has come in has only seen the good part of equity. They've not seen volatility. Their temperament has not got tested at all, and now it is getting tested.
So, Nikunj, I think that's a excellent point you made, and I mean I fully agree with that. And so easy money, I mean, seldom lasts long, and but so while there will be disappointments for many, I think especially the direct investors, because given the way markets were behaving, I mean, my guess is that a lot of the retail activity was focused on the more, speculative or more expensive or more volatile kind of stocks. So I think, yes, it could lead to some pain. It would have probably led to some pain. But the fact remains that equities have become a far more mainline asset class than they ever were. And I think a large number of these investors will not lose faith in equities, but they will probably try and introspect or learn that what mistakes have they made, and they will probably become better investors next time around. And this is what happens to everyone. It has happened to me. I mean, right in the beginning of my career in early 90s, I made mistakes, and those mistakes have kept me in good stead. So I think the number of new demat accounts that have got opened in last 2 3 years, almost 5 6 crores. While some disappointment is likely, I think a fairly large number of them over time will adopt equities in a better way, and which will eventually lead to better outcomes. So I don't think that net the retail investors are going to turn sellers. That's not my view. But of course, things could turn out to be quite differently as well.
When you say return expectations should be moderate, is it largely because of price, or you think markets will get disappointed on the earnings front? Because now we are getting evidence that demand is not as strong as what we, let's say, thought 3 months ago. Rural demand is not reviving. Inflationary pressures are visible. So do you think moderate return will be a function of the starting point of valuations or earnings disappointment?
So one can say inflation is a pass-through for equities. So higher inflation means higher selling prices, and therefore it's normally a pass-through. So inflation that way is probably not as much of a worry in India right now. I think the local demand has clearly been weak, and as I said, even credit growth is not picking up. So that is a concerning sign. Hopefully, things will improve over time. But again, see, 1-2% higher or lower growth in a year does not impact equities that much as the underlying valuations and the cost of capital. And this is what we had discussed immediately after budget also, that the starting valuations in India are expensive. India's market cap to GDP, P multiples are moderately above long-term averages. So one should have moderate expectations of returns. One should invest only for long periods, and one should again be prepared for volatility. Because see, while hopefully what is happening now, it will stop hitting the headlines after a few weeks. But I think the US interest rates, which have come down from mid single digits in around 2005 to around 1% sometime back and 2% now, how high they go, where do they settle? I think that is still a issue that is wide open, and that could have some impact on capital markets across the world. So I would say, while remaining optimistic, but one should still have moderate expectations and only invest if you are prepared for volatility and can invest for the long term.
There is empirical data and anecdotal evidence which indicates that markets outperform in the first phase of rate hike, whether it is equities or whether it is financials. If you are indeed in the first rate of hike, do you think history will repeat itself?
And the logic for that, why that is experienced said is or has been experienced, is because rising rates means economic demand conditions are very strong. So I don't know to what extent history will repeat itself, but I would say, I mean, again, in my experience, while the economic variables are many, and they keep on changing, but medium to long term returns of markets are best correlated with the uh, valuations around the time of investments. So even if economic growth is good, if it is priced in, you may still get average outcomes. If the starting valuations are very low and economic growth is weak, you may still get good outcomes. I think valuations are suggesting that it is time to think long term, be prepared for volatility, control your risk, and be prepared for moderate returns. I mean, I may repeat one more thing what I had mentioned some time back, that this is not the time to leverage and invest in equities. And I had also highlighted the F&Os, why one should be extremely cautious. And you can see a small bit of volatility gets extrapolated far more in F&O, and it could lead to very negative outcomes. So I think this is a market where one should be cautious, one should control risk, not leverage, remain diversified, focus on value, think long term.
Prashant, let's get to that good old debate which we've always had and which you've argued on several shows and several platforms, growth versus value. I'm going to start with something where I'm trying to understand the definition, or we are trying to understand the definition. Where does IT fit in? Is it growth or is it value?
IT is clearly a growth sector. I mean, both its characteristics, it's a growing sector. It has grown without a break virtually for 3 decades now. And it is also valued like a growth sector. So it is clearly, though some people hold the opinion that given the strong, solid demand conditions, it is likely defensive as well. So some people call it a defensive sector, but to my mind, it would not fall under the value category. Nikunj, not able to hear anything now.
Right now, okay. My next question, Prashant, is
Yeah.
you mentioned that credit growth is not very strong. Now, what happens in a scenario to financials when credit growth is not very strong? Financial stocks got re-rated, and especially corporate banks, because the best of the NPA cycle, worst of the NPA cycle is behind us. But if best of the credit cycle is not coming and we are getting some delay there, what will happen to banks and financials?
So I think you are absolutely right. The NPA cycle is behind us. The credit cycle is behind us, and we are waiting for the capex cycle to start, for the a new credit cycle to emerge. And thus far, it has not happened. I think the economic conditions for them to change, it takes much longer than our typical time horizon, where we tend to look at data every week, every month, every quarter. So I remain optimistic that credit growth in India will pick up at some point of time. Inflation is clearly supportive of credit growth. Retail loans in India continue to grow. Home affordability is good. We are seeing significant improvement in infra capex, and we are also seeing good evidence of revival in industrial capex. The challenge is for credit growth is that the corporate balance sheets are extremely healthy and cash accruals are good. So when you announce a project and when you actually spend money, first, I mean, there is a lag there, and then you will spend your equity capital. And once you run out of that, you will go to the banks to borrow more. So I think there could be some lag in credit growth. This again we had discussed, but clearly up till now we have seen no evidence of improving credit growth. It continues to languish around, I think, 8% odd. And to come back to your point, I think if current credit growth conditions remain, I think a further re-rating in banks will have to hold on for some time. I think that is more likely only when there is a clear evidence of faster credit growth.
You bought Pharma stocks in the past, and in the last interaction, you did mention that selectively Pharma is now pricing in a lot of bad news. Could 2022 be the year of comeback in Pharma?
Yes, Nikunj, I mean, I remain optimistic. See, pharma is a very diverse sector. There are some companies focused on local formulations, which is more or less a secular growth story. But there also some challenges are emerging. Distribution is undergoing a change. E-pharmacies are coming. So uh, that is one. In the US, there have been considerable pressure on generic pricing that continues to impact companies. But if some companies get some interesting approvals, large approvals, they could do well. So I would not be pessimistic on pharma, though honestly, in this market, there are very few sectors where there is uh, real good value. So where you can set return expectations aggressively. I don't think pharma would also qualify in that space.
You did mention last time about this good old comparison of mid cap versus small cap, but post that stocks have come down 20%, 30%, 50% in some cases. Is it now a good idea to relook at mid cap, or they do not fall in your comfort zone?
I think I mean, to my mind, the excesses that we saw in some of the, these companies, the new age companies or the small mid caps, I think were very large. And in my opinion, even currently, I mean, while here and there some value might have emerged, I would still be cautious in that space.
We spoke a lot about PLI schemes, manufacturing themes. Are you satisfied with the way how things are progressing? Look, PLIs have been rolled out. Things are looking up, but are things looking up in the right direction, or right now it's theory and implementation is still a distance away? I'm talking about the manufacturing sector.
No, I think there is every reason why manufacturing in India should do well. We are moving in the right direction. The challenge is that markets have run too much ahead of, if you look at some of these contract manufacturing companies, for example, some of the chemical companies, I mean, the multiples are just too high. So while yes, the sector will grow, but if you look at the stock prices, they are up many, many fold over times. And growth, of course, takes time. So even if you double a business every 3-4 years, over 10 years, the business will become 6 to 8 times. But if the stocks have already gone up 20, 30, 40 times, I think that's why even last time around, we had discussed the chemical space. So I was quite cautious. And even today, I feel the multiples are quite rich. And in some of these cases, because of various supply bottlenecks or various issues, the earnings have gone up very sharply, which is not sustainable. So I don't think we should look at multiples in some of these cases at today's earnings. We should figure out more sustainable level of earnings, and based on that, these stocks will probably look even more expensive.
Prashant, you've always said that never say never, and I'm going to use this example for the benefit of our viewers because I have an advantage, or we have an advantage of interacting with Prashant. There was a time Prashant did not have auto stocks, and there was a time we bought into auto stocks. And the classic case here is Maruti. No exposure to Maruti, stock came down, all the bad news was in the price, you bought into Maruti. Now, why I'm asking this question, Prashant, is that if you look at the internet companies, when Paytm went public in the prospectus, they had mentioned that we don't know when we will make profit. Last night at the JP Morgan conference, Paytm for the first time is talking about a path to EBITDA profitability. So do you think after the recent sell-off in some of the internet companies, promoters will get conscious about profits and cash flows, and this could be a good turning point for some of these companies?
There are two issues here. See, in some cases, the value proposition or the strength of the business is such that the path to profitability is visible. And in some, even that is not the case yet. Now, even when the path to profitability is visible, it's a part of strategy, how much you want to keep on investing in new customer acquisition. Because the more you keep on investing in future growth by way of new customer acquisition, the more delayed your profits will be. So I think the best way to value these companies is to try and get us handle about their long-term profit potential. And that is how you can roughly work on these numbers. These are extremely, I would say, approximate estimates, and I don't think, it's partly guesswork, partly, I don't think there are very clear answers. But my view remains that some of these businesses will turn out to be extremely successful. Not all of them, many will not do well. But after this correction, I think, there is some maybe value compared to where we were earlier, but I am still not convinced that there is good value in these names.
Prashant, how do you see metals, energy, and other pockets moving? There is a supply side disruption which has affected supply chains. There is a greenflation which has kicked in. There is suddenly a normalization of demand. Everything has just got up and down in last 12 months because of policy, because of demand, and because of logistics. How do you see the energy complex moving? How do you see the metal space moving now?
And now there is a fourth variable, and that is the current geopolitical environment. So this is, I think, a key issue, and I don't think one will have very clear answers to this. But earlier we have discussed, others have commented on this, that because of underinvestments in the energy space and the economy opening up, supply bottlenecks, bunching together of demand, whatever, we were experiencing significant energy inflation. And when there is inflation in energy, it will feed through to other commodities, because metals again are one of the key inputs to making metals is energy. So I think given the current, the earlier issues, they remain. The underinvestment of the past, the green inflation, those issues remain. On top of that, we have this small, not small, maybe this new geopolitical development. How much does it impact oil prices, energy prices over time? I think it's more guesswork, and there is very little science to this, because we don't even know clearly what is coming. Though I do feel given the strong dependence of Europe. See, what is happening now is in the backyard of Europe. It is not happening in some remote corner of the world. So to that extent, I think there will be a lot more pragmatism when dealing with these issues. So I do feel if things stabilize in few months, 1 or 2 quarters, we will again come back to the same old issues of underinvestments in energy in the past, and uh, uh, the demand side will take much longer to get impacted, but supply side of energy is getting impacted far more. And therefore, I think one should be prepared for slightly higher energy prices for some time. Though I must say that inflation measures change year to year. So even if energy prices remain high and stabilize there, its inflationary impact after some time would not be much.
I'm going to wrap up today's discussion with something which we've discussed, argued, and debated. But sometimes you have to say the same thing again and again as a reminder to our viewers that what they should do in these times of panic and these times of uncertainty. What looked like a carnival in the month of Jan, you're getting a feeling of mortuary suddenly. But that is the nature of the market, isn't it? What about asset allocation after the recent decline? Because you got a bond market where interest rates would move higher, yields are nearing 7%. You got equity market which has seen a sell-off. For a medium to long-term investor, share your thoughts on asset allocation, and then we'll wrap after that.
So Nikunj, I don't know if it was with you or in some other similar interaction. I had repeated what Warren Buffett had said, that stock markets is a place where those with experience get money and those with money get experience. And what I meant out there was that we have seen 5-6 crore new demat accounts opened in last few years, and everyone seems to have made a lot of money. So I had cautioned clearly, look, this is not the way it will remain in the long term, and one should understand what one is doing, and one should be cautious in FNOs. And I'd also hope that once this price of learning has been paid, hopefully there will be course correction and people will invest sensibly. So I think that clearly remains. I mean, so one should not leverage in these markets. I think those who are leveraged, I am sure it has caused immense pain, and gains of 2 years can get taken away in 2 weeks or 2 months of time. So I think that clearly is one. Second, I think again, given where valuations are, given that the fact that cost of capital is likely to rise, also given the fact that India's economic outlook is positive, I think while one should remain optimistic on markets, but clearly one should have moderate expectations. By moderate, I mean maybe low double-digit kind of CAGR returns over 3-5 year periods. So invest only that part of your capital which you don't need for 3-5 years, where you can handle volatility, where you can handle loss of value for some time, both emotionally and financially. So I think if one invests in that way, I think things should turn out to be quite okay.
It's very rare that I get to sit in between two wise men. I've got Nilesh Shah on one side, Prashant Jain on one side, and I'm right in the center. So I don't want to say anything right, but it's a rarity for me to see two wise men, one on my left and one on the right, talking about markets right now. Nilesh bhai, good morning. Prashant is there with us. I mean, I'm just saying that, bhai, it's my good luck that I've got two wise men, one on my right, one on my left. I'm in the center.
So Nikunj bhai, ye Trimurti hai. This is Trimurti of all three wise men.
No, sir. You both are much more experienced. I'm a market commentator. So, Prashant, really appreciate your time. Thank you for joining us. I'm going to move from one wise man to the other wise, Nilesh Shah of Kotak AMC.